Hello everybody, welcome back to another valuation investing video. And today in this video, I'm going to be giving AI my entire stock portfolio, and I'm going to be letting AI review the entire portfolio and see what AI has to say about my positions. So with that being said, let's get into what my portfolio actually is first. Then we will let AI rank my portfolio. So getting into what my portfolio looks like right now, here we can see my allocation by value. Here I have my biggest position of Google at about 33.9%. The second largest position I have is ASML at 29.3%. Then I have Visa at 23.4%, then Fortinet at 10.1%, and Meta at only 3.35%. Meta, if you haven't watched one of my recent videos, is a very new position. I just started buying. So with that being said, this is a starter position. I would like to see Meta at least 10% of my portfolio in the future. So with that being said, let's give AI my entire portfolio and let's see what they have to say. But also taking a look here, with this, we can see the portfolio quality analysis. I get 6.5 out of the 7 key metrics with my portfolio. As we can see, everything with the metrics looks very good. The debt to free cash flow looks very good. Shares outstanding are decreasing. The EPS growth very fast. Revenue growth also very fast. They're good at reinvesting back into their businesses, all my stocks. The only thing that isn't great is the Ford P ratio at an average value of 31.5. So my stocks are a bit expensive premium wise, but I'm not too worried about that because I believe they're such high quality businesses that they're worth these valuations. So with that being said, let's give them my stock portfolio. So with that being said, going over to ChatGPT here, I've given them my entire portfolio with the positions here. I have first Google with an average price of $153. 33.9% of my portfolio. Then I have ASML with an average price of $675 at 29.3% of my portfolio. Then Visa with an average price of $263, 23.4% of my portfolio. Now Fortinet at an average price of $75, 10.1% of my portfolio. Then finally, we have Meta with an average price of $718, only 3.35% of my portfolio. That is a very recent addition. I just bought that about 2 days ago. So with that being said, let's submit this to AI and see what ChatGPT has to say. So let's go and get into ChatGPT right here. So this is what I expected with ChatGPT to say, that my portfolio is not diversified enough. As we can see here, your portfolio is quite concentrated, only 5 names, and tilted heavily toward growth, tech, semiconductors, digital payments, and cybersecurity. This means you have a high beta exposure. You'll likely see strong upside in good markets, but also downside in risk-off environments. Your largest holdings together make up 83% of your capital, with Google, ASML, and Visa making up that. So that is what I expected for AI to say with the impressions of it. That's a lot of concentration risk. If any of those stumbles, it can drag your whole portfolio. You do get some diversification in business models that helps mitigate if tech falls, everything falls, they say, to some degree. But the common factor is still technology, digital infrastructure, or high growth secular themes. So this is definitely what I expected AI to say. I'm too concentrated in these stocks, but I personally do believe that diversification can make your performance even worse. If you take a look at what Warren Buffett has said in the past, diversification can actually harm your potential gains, and diversification is meant for people who are ignorant. So with that being said, I think having a few positions isn't the end of the world if you truly believe these are great companies and will continue to grow and don't have that much risk. And I truly believe Google, ASML, and Visa are all great companies, and I think they have a very high good growth rate for the future. I think there's a very high chance that these companies outperform the market. And it also says you're leaning heavily into secular growth trends. That's not bad. Those are where a lot of future upside lies, but you also accept more volatility and more execution risk. But let's get to the positives here. Looking at the positives, we have secular tailwinds. Many of your picks are in sectors likely to benefit from long-term trends: AI, cloud, cybersecurity, digital transformation, and payments. This gives your portfolio a thematic edge if those trends continue. Upside potential: with concentrated bets, you can outperform if your calls are right. So that's what I believe. Quality names and moat potential: some of your holdings are leaders in their niche. Some of your holdings are leaders in your niches. This gives you a chance for more durable competitive advantages. Also, with growth plus value mix, you have some exposure to more mature cash generative businesses and some high growth, higher risk ones. That gives you some balance, so that's good. But here are the negatives. The negatives here are high concentration. Like we said, the failure or negative surprise in one name could disproportionately hurt my portfolio. Lack of defensive diversification: you have almost no exposure to sectors like consumer staples, utilities, healthcare, or value plays that might hold up in downturns. Volatility and drawdowns: in a tech sell-off or macro downturn, your portfolio is likely to suffer significantly. Tail risk and black swans: because you're in a high growth, high innovative areas, regulatory changes, supply chain disruption, trade wars, or major technological shifts could hit you hard. Overexposure to technology: if tech valuations reset, momentum stalls, or interest rates remain high, your portfolio may be more sensitive. But let's get to the position by position analysis. First, we have Google here. Position weight of 33.9%, average price of 153. Positives: very strong free cash flow generation, diversified revenue base, dominant in search, YouTube ad ecosystems, benefiting from continued online ad growth, exposure to cloud infrastructure, AI research, relatively more stable than pure growth stocks. However, some risks here are advertising is cyclical and vulnerable to budget cuts. We also have regulatory antitrust risk globally. Growth in other bets has often been slow or loss-making, and competition in AI. Google is often a core holding in growth portfolios because it balances growth and some stability. If interest rates fall and earnings multiples expand, Google has room to run. But it's not a pure moonshot bet. It's a solid growth with moat name. So let's go over and let's look up Google stock in my stock analysis. So going over to Google, let's get some more in-depth on Google stock. So taking a look here at Google, we can see the stock looks pretty good. It was up just yesterday, I think. Today's Saturday, so yes, this was yesterday. The market's closed today, but take a look here. The market cap of almost $3 trillion. The forward P ratio is at 27, so pretty good. Free cash flow yield's a bit low. Normally we want to see that in the 3 to 5% to have a good value. Also, the margins look good. The net cash is what I really like about Google here. $53 billion in net cash. So let's go over to the 7-step stock analysis. Taking a look here at my 7-step stock analysis, we get 7 out of the 7 key metrics. This is why I have Google. I think it's a very good fundamental company. Let's go to the intrinsic value calculator and get an intrinsic value of today's price. Bear case, I'm going to put a revenue growth of 8%. Base case, I'll do 10%. Bullish case, 12. For the profit margin, right now they're at about 30%. I think bear case, this company will be 28. Base case 31, and then bullish case 34. I'm going to be going through this a little bit fast because I've made a bunch of videos about these companies, and I also want to get into the other positions in a timely manner. So with the future P ratio, a company like this growing 8% probably deserves a 20. Base case, I think a 24. Bullish case 28. Now for the shares outstanding, they buy back at about 2% each year. So I'm going to do negative 2%, negative 2.5%, and negative 3. With that being said, looking at the intrinsic values for Google, I still get today a 10.9% annual return, even though we're near all-time highs. And if you want to make a 10% return, I would say be buying under $256, and I think you can make 10%. And with the bear case, if it's under 170, you can still make 10%. That's why I really like Google, and this is my biggest position. At an average price of 153, I personally believe I could be making 15 to 20% each year. So with that being said, let's get to the other position. Now, taking a look at ASML here, as we can see, this stock has really been rallying. Over the past 6 months, look how much ASML is up, 70%. So with that being said, the position weight of 29.3% and an average price of $675. Here are some positives for ASML. Very strong fundamentals among its semiconductor equipment peers. ASML is highly rated for profitability and return on investment. Dominant, almost monopoly position in EUV lithography. Very few direct competitors for cutting-edge machines. It has negative net debt, strong solvency metrics in many assessments. long investment cycles in chip manufacturing, and exposure to the AI high performance computing boom. Some risk here is export controls, geopolitics. ASML is affected by US Dutch export restrictions, which weigh on its growth potential. Also, we have the next generation adoption delays. The newer generation of lithography machines is costly, complex, and uptake is slower than initially hoped. Some forecasts suggest only a few shipments in 2026. Also, valuation risk. A lot of future growth is already priced in, and dependence on capex cycles, which is basically, I think, ASML will do very good if companies are spending a lot on capex, which they have been. So that's why the stock, I think, is doing good. But this is a more cyclical company. So ASML is one of your highest risk, high reward bets. If the AI semiconductor capex story plays out and geopolitics don't derail things too badly, this could be a major winner. But delays or regulatory constraints could temper results. Personally, I like it as a core big innovation infrastructure play, though I'd probably not let it dominate this heavily. So let's go over to my stock analysis website. If you want to go check it out, link is in the description, or look up valuationinvesting.money, and then you'll just get to this website. You can get a 7-day free trial, and you can get all access to this. You sign up through Patreon, so then you also get access to the Valuation Investing Patreon. I think this is worth it. Honestly, I think it's great, and you can go and check it out. But let's get into this right here. With ASML, we get 6 out of the 7 key metrics. The forward PE ratio is the only thing that's bad. This thing is getting pretty high now. 38.6 forward PE ratio. It continues to get higher. I bought this company with a trailing PE ratio of about 25 or so. So it's getting really, really expensive for their earnings. But take a look at everything else. Everything looks very good. Debt to free cash flow, very good. Shares outstanding, good. Growth numbers look very good. I really like ASML. Getting into the intrinsic value calculator, I think for the bear case, we'll see this company grow 8%. Base case, I'm going to do 13%. Then bullish case, I'm going to put, let's do 18%. Bullish case, I'm saying capex continues to increase and a bunch of companies continue to keep buying their machines. Now for the future profit margin, I think this is a pretty fair future profit margin. Very similar profit margin to Google. I actually think that this could increase more because of the huge moat they have. Now for the PE ratios, I think base case, this company deserves a 26 PE ratio. Bullish case, 32. Now for the shares outstanding, I think for the shares outstanding, they will decrease it, but let's do decrease by 0.5%. Then base case, let's do decreasing by 1%. Bullish case, 1.5%. So that's what I believe they're going to be buying back shares. They've been buying back at about 1%. Take a look here. I think you can make about 8% return if you bought it today. So me personally right now, I'm not buying anymore. I actually sold 1 share of ASML. So it didn't take away a lot from my position, but I did sell 1 share. But I still think this is a great company. I sold 1 share just to get some cash. I believe the market is a bit high right now, and I think I'm taking some profits. Definitely not a lot of profits, but I've been taking a little bit, just a teeny bit. But take a look here, 8% return I think you can make if you bought today. So right now, me personally, I wouldn't be buying ASML. I think to buy this company, you'd have to be under $850 for me. So that's what I believe. I think this company's just getting really high. I think with the earnings coming up, that's going to tell a lot for the future. Now, the next stock we're going to be looking at is Visa, as we can see here, with the position weight of 23.4% and an average price of $263. Positives is the very stable business model with strong free cash flows, benefits from the global trend of digital payments, commerce, contactless, and fintech expansion, also has a wide economic moat, less volatile compared to pure tech plays, opportunities for growth in cross-border payments. However, some risks are competition and disruption from fintech, regulatory and antitrust risks, slower growth in digital payments in saturated markets, currency risk, and macro exposure. With the outlook, Visa is a strong core in a growth-oriented portfolio. A relatively safer growth name, it helps diversify away from pure hardware-software risk. Unless competition or regulation severely impacts it, I'd expect steady returns and earnings growth over time. So let's take a look at Visa in my valuation investing platform. Let's look up Visa stock. Let's go over to the 7-step stock analysis. Once again, another great company. 7 out of the 7 key metrics here. Get everything looks good with Visa. That's why I have it. All these companies look very good. The only thing that's X's with all these companies is the forward PE ratio. So with that being said, looking at Visa here, they've been growing at about 10% each year. I think they're going to continue to grow at 10%, and then bull case 12. I think 8, 10, and 12 is very fair for Visa. I think that they're going to just continue growing at this rate. This company is very consistent. I don't see anything changing. But for the future profit margin, this company's at a 52% profit margin. So with that being said, I think bear case 51, base case I'm going to do 53, bullish case 55. I think this company could get even more efficient in the future. With the future PE ratio, I honestly think for Visa, this is a very consistent company. I think bear case we can do a 22 PE ratio. Base case we can do 26. Bullish case, let's do a 30 P ratio, I think is fair. Now for the shares outstanding, I think we're going to do 1.5, 2, and 2.5. They've been buying back at about 2% each year. With that being said, for Visa, I get about a 6.6% return with Visa today. So right now, I don't think Visa is a great time to be buying. Me personally, if you think that this profit margin can get higher or future P ratio should be higher, then maybe. But with that being said, target price to be buying more is basically near where, if I wanted to be buying Visa, it would definitely have to be under $300. If it got under 300, I'd probably be willing to buy because this company is such a high quality company. I'd honestly be willing to only get a 10% return with this company potentially, just because of the stableness and high qualityness of Visa. Now going over to the next stock, we have Fortinet. As you can see, position weight of 10.1%, average price of 75. If you don't know what Fortinet is, they're a cybersecurity company. As we can see here, active in a high growth secular domain, cybersecurity network safety. Recent quarter 2 2025 results were solid. Revenue growth of 14%, billings growth 15%, and growth in ARR and security offerings. Strong fundamentals in some metrics, manageable debt, robust free cash flow, favorable ratios in some analyst views. Analyst outlook is modestly positive in many cases. Some bullish views exist. Here are some risks and headwinds. Execution and renewal cycles matter a lot. If product refresh is delayed, growth can slow sharply. In fact, some recent weaknesses was tied to refresh cycle concerns. That's why in their recent earnings report, the stock was down 25% because there was a high renewal cycle, but the growth wasn't as fast as they thought. So that was concerns for investors. The only thing I don't like about Fortinet is the competition. They don't have a huge moat compared to other companies, and that's why it's such a smaller position in my portfolio. Dependency on improving product mix, margin expansion, and maintaining innovation. Valuation expectations might be demanding. The room for multiple expansion may be limited in the near term. Fortinet is a nice growth satellite in your portfolio. At 10% allocation, it's a reasonable bet. Potential upside if cybersecurity demand stays high, but also a name where you want discipline and a stop loss or reassessment trigger built in. So with that being said, I think Fortinet is a definitely more riskier investment. That's why it's a smaller position in my portfolio. I'm not as confident with this company to consistently give me gains. I'm not saying I'm not confident that this could outperform. I just don't think it could consistently. I think it's still a great company though, don't get me wrong. As we can see here, we get 6 out of the 7 key metrics. Forward P ratio, the only thing bad. Return on invested capital at 50.1% is amazing. That's very high. These growth numbers are insane. The only thing I don't like is the deceleration of growth with this company. Shares outstanding going down. Debt to free cash flow looks good. We can take a look at the charts and see the deceleration of growth. It's not too bad, but it's definitely decelerating, which I don't love. But going over to the intrinsic value calculator, I think bear case this company grows 9%. Base case, I'm going to say 13%. Bullish case, I'm going to give this company a 17% revenue growth. I think this company will benefit in the future. This company's still a great growing company. I think they deserve a 13% revenue growth for the base case. Now for the profit margin, right now they're at about 31%. So base case 28, bear case 28, base case 31, bullish case I'm going to do 34. So I think that's fair for the assumptions. Now for the future P ratio, I think 22 is fair. I think this should be higher, probably 20, let's do 28. or let's do 27 actually. Now for the bullish case, I'm gonna do a 32. Shares outstanding, I think this should be fair. Let's see, let me make sure, 1.8% they're buying back, so I think this is fair. Now taking a look at the intrinsic value calculator, at today's price, I can get a 10.4% return with Fortinet, and my average price is at about $75, so I think I can still get a probably 12% return with Fortinet in the future. So I think Fortinet's a very good company. I am a little bit more worried about Fortinet because of the competitive nature of cybersecurity industry. But getting to the final position in this company I've just been buying. I just recently bought this right around here. I think it was at $718 just a few days ago. My position weight only 3.35%, average price of $718. Here are some positives with this company. Very strong fundamentals, profitable, strong cash flow, dominant in social user platforms. Also, major bet on metaverse, VR, and AR, but still strong core of advertising. If some breakthrough or renewed growth in next generation platform occurs, Meta stands to gain disproportionately. Also, because your allocation is small, the risk is limited. But looking at the risk, growth in their future verticals has been slower and capital intensive. Advertising growth, regulation, and privacy constraints could be bad for Meta. Valuation is under pressure in tougher macro environments. Also, execution risk. Given your small exposure, Meta is strategic bet rather than a foundational holding. If things go well in social plus immersive next-gen interfaces, it could reward you. If not, the downside impact is limited because of its small weight. So going over to Meta stock here on my platform, let's type in Meta. So going over to Meta stock, let's go to the 7-step stock analysis. As we can see here, we get 7 out of the 7 key metrics. Another great company, fundamental wise. I love Meta. I want to add a lot more. I hope the stock goes down a lot because I want to buy it. So going over to the intrinsic value calculator, I think bear case, Meta will grow 8%, base case 12%, bullish case 16%. I think Meta is just going to continue to grow and beat expectations, even though they're expected to grow at 13% over the next 5 years. So this is actually kind of conservative. Bear case for the future profit margin. Right now, their profit margin is at about 40%. So I think bear case, we can do 37, base case 40, bullish case 43. I don't think the profit margins will be able to increase that much faster. Now for the future P/E ratio, I think bear case, they deserve a 20 P/E ratio. Base case, I'm going to do a 20, let's do a 25. Bull case, let's do 30. Now, for the shares outstanding, I think this is fair for Meta. They've been buying back at about 2%. With that being said, I get an annual return of 14% for the base case. This is why I've started to buy this company. I think with a 10% return at $850 for the base case, I think this is enough margin of safety to start buying Meta, and that's exactly why I've been buying it. So that is the overview of all my positions. Now let's get into the portfolio grade. As we can see here, given everything, you have a strong conviction in your picks, which is good, but that conviction is concentrated. You've picked quality names, many with durable moats and exposure to big secular trends, but the lack of defensive diversification is vulnerability. The success of your portfolio is going to hinge on macro, regulation, geopolitical stability, and successful execution in high risk. If I had to rate your portfolio, I'd give it a 7.5 out of 10. 7.5 because I think this is a high upside, high volatility portfolio with decent prospects, but it's not foolproof. There's room for improvement in risk controls and diversification. So with that being said, I think, I'd personally rate it 9 out of 10, 10 out of 10. But I do think AI does factor in a lot with the diversification, because a lot of people in the finance industry really get set on diversification. How many stocks should I have? My answer to that question is, how many stocks are great businesses? How many great businesses are trading at a decent valuation? And then that's how many stocks you should have. And me personally, I can only find 5. I'm sure there's more out there, but I only have 5 right now that I'm willing to be in. And I personally think that diversification can definitely hurt you in the long term. I'm not saying that when I'm a younger person, I think as an older person, you should have more diversification. But as an 18-year-old, I think I should have less diversification because of the future potential of that. So thank you guys for watching this video. on AI grading and taking a look at my portfolio, please subscribe, hit the like button, comment down below, and give me some feedback. Also, if you want to go check out my Patreon, you get full access to the stock analysis platform. Click the button right up here. It should look like Valuation Investors, it should say. You can go and sign up, 7-day free trial. If you want to go take a look at that, you can get full access to everything, the Patreon and the Valuation Investing platform. Thank you guys for watching, and see you.